right, boys and girls, you've had your fun, and you've got to earn your money. My name's Arthur Sinodinos. I'm at the Asia Group these days, former Australian ambassador to the US. I was there for 3 years and a bit as ambassador at a time when the world was changing. Look, it always changes rapidly, but it really felt the last few years like that pace was accelerating. You know, we used to speak longingly about free markets, small government, low tax and deregulation, open trading and investment system. But we're seeing a world where globalisation seems to be fragmenting. The talk is now these days of de-risking, if not decoupling. And we're seeing supply chains come under pressure, reshoring and friendshoring, as we call it. COVID and geopolitical tensions have been very much at the fore of driving this sort of change, and strategic industry policy is back in vogue. And I think the Secretary of the Treasury at lunch, I missed that part of lunch, no doubt gave you a rigorous underpinning to how economic security should be interpreted in that context. And so what we're seeing increasingly are minilaterals emerging, AUKUS, Quad Investor Network, of which I'm a member, new forms of industry integration between countries, particularly in our own region, the Indo-Pacific. And some of the events of the last few years have meant that ESG these days has an extra G, and that's geopolitical. I remember when I was in Washington, I got a call from the CEO of a large Australian company in Russia. And he said, we're trying to work out what to do. I said, well, you'll have to take into account the reputational implications of looking like you're staying in Russia and therefore complicit in what Russia has done in Ukraine. And they did actually, wasn't just because of those comments, but they did look at their situation in Russia, looked after their people, but got out. And this is increasingly the world in which business and corporates operate. So what we've done today is gather an expert panel to discuss the global and domestic ramifications of what's going on. The panel, Ziad Haider, Global Director of Geopolitical Risk at McKinsey & Company. He's not charging anything for his appearance here today. Ziad has been writing prolifically on the issue of the geopolitical risk function and what corporates should be doing to better take account of geopolitical issues in their corporate strategy. Sally Auld, Chief Investment Officer at JB Weir. I used to work there as well, and she has a fantastic reputation for being a great analyst of financial markets and investor perspectives. And our third panelist is Nev Power. Now, Nev has a number of strings to his bow, but one thing that struck me about Nev was the fact that he survived as head of Fortescue Metals for quite a long time. That's pretty good. You did a good job. And these days, he's a corporate director and someone who also played an important role in helping coordinate the COVID response. And he's one that can provide some great industry perspectives on the mining sector, on supply chains, and so on. So we'll get the thing started, because these are the people you should be hearing from, not me. So we'll start with you, Ziad. Welcome. Now, you've been doing a lot of work in recent years on the geopolitical risk function, and you talk in terms of corporates having geopolitical resilience. In your mind, what does that mean, and how does it manifest itself in corporate strategy?
Thanks, Arthur. No, well, good question, and firstly, I just want to thank the audience for their resilience to bear with the second round of remarks from me, so much appreciated. Geopolitical resilience, we heard over the lunch address about economic resilience, but maybe I'll start this way. When we poll our CEOs as part of a regular survey we do and ask them what is the top risk on their mind, by far the top risk is geopolitical risk. What's the fastest, newest emerging risk on their mind? Interestingly, for many of them, it's a different kind of risk, which they refer to as political transitions, and which we interpret as elections. That's particularly true for European companies and CEOs. So on one hand, you have companies saying that the top risk that they think about is geopolitical risk, and the top emerging risk is political transitions. But here is where it gets interesting. In those same surveys, when we ask them what is their top priority, managing geopolitical risk is probably number 5 or 6. Way above that are things that are much more fundamental in their minds, like growth, like harnessing new technologies and so on. So you have a bit of an asymmetry, and our interpretation of that is that it is because for many, not all, but for many companies, the idea of understanding the problem sits alongside not having a lot of great solutions of what to do about it, because it is such an elastic and diffused issue, geopolitical risk. But we would submit that there is a bit of a method to the madness, and I'll just sketch out, Arthur, 3 domains where I'll end up spending a lot of my time with clients on. The first one is about insight, and it sounds very elementary, but if you were to ask a typical board or a CEO, what is your source of insight on geopolitical risk? It would probably be some combination of, well, I get some updates from my team. We have a speaker who comes to the board, a big name person maybe once a year. And I read something in The Economist, and we just kind of string together the insights, and it's somewhat of an impressionist painting. But I think those days, as you can all appreciate, are very much gone, and the need for companies to have a very clear, aligned baseline of the facts, right? And I say that because in a global organization, people are reading different media sources. Where you sit is where you stand. Geopolitics is personal. So as a result, how do you invest on a clear source of insight? For some companies, that comes from the government affairs team, from legal. Some have advisory council, some have a vice chair. Many of the financial services firms have that model. But the idea of having a geopolitical risk unit, wherever you lodge it, as an eye in the sky, a satellite, that helps your organization think about global positioning, global pattern recognition, that has become a key theme. So the first muscle really for this geopolitical resilience feature is insight. I think the second thing that comes from that is really if you have that insight, then you can exercise what you need to run your organization and steward it, which is oversight, really. And a recent piece that we put out looks at the different moves that companies are having to explore on 6 key dimensions. So supply chains, R&D, people, capital and ownership, legal entities. And so in each of these dimensions, if you look at the world today, companies are having to think about, with the benefit of this insight, how should they structure themselves? Let's take tech stacks, for example. Many companies are building completely localized tech stacks in China for security localization reasons. Others are choosing to say we'll have some minimum connectivity to the global platform, and still others are saying, no, we're going to have to maintain a global tech stack because it's too inefficient, too costly, so on. Same thing with ownership. In different markets, companies are having to make different choices. Let's just look at McDonald's, right? In Russia, it exited. In China, it has a local JV. In the Middle East, in the wake of the conflicts that have been playing out, a local franchise was reacquired by the global corporate parent, in effect, to mitigate some of the risk. So my point is that the oversight that companies are having to exercise to build resilience means thinking critically about the dimensions of their entity and making a range of moves from local to global. And I'll just round out with this third last point, which is insight is important to understand. Oversight is important to mitigate. But if anything we've learned from COVID, from Russia, Ukraine, in Asia, exactly a year to the month before Russia, Ukraine, was another incident, which was the coup in Myanmar that sent companies scrambling for the door. We have learned the value of alongside insight, oversight, foresight. How do you look around the corner and anticipate risks and opportunities? And I'll just leave it by saying that the way at least we talk to our clients about it is that you've got to be thinking about perceiving the future in a few different ways. There are the black swans, the unknown risks of high impact. There are the gray rhinos, which is a term that refers to the known risks of high impact, which I alluded to. But there's also, importantly, the silver linings, and I know we'll reflect on that together. And if you think about that mindset of what could be the black swans, the gray rhinos, the silver linings, of those which are the most material for a company, and how do we prepare for the various shocks that emerge from it, that leads to a discipline around scenario planning and contingency planning, more importantly, that I can elaborate on. But hopefully, just that strength, that suite of insight, oversight, and foresight are the key elements that we see of building geopolitical resilience.
Just a quick follow-up to you, and then we'll go to Sally. The scenario planning that you talk about, in the 80s, Shell used to have a good reputation for doing scenario planning. Are there models in your mind of companies that do this well today?
Yeah, I think there are different. So firstly, I think it's worth, Arthur, disaggregating scenario planning from simulations from wargaming.
Yeah.
These words are all used interchangeably. The way I see companies use scenario planning effectively is they would say, for example, where is China going to be in 50 years? Where do we want to be? What are the different world's end states we see? How would we position ourselves, right? It's a long-term view. That's more of the scenarios. There are others that are running simulations, which is, if A happens, how do I respond? And those simulations are usually around 4 kinds of shocks. Kinetic shocks, so there's a military event that happens. We all know what those are in this region. Regulatory shocks, there are sanctions, restrictions, and so on. Market shocks, significant market slowdown, backlash in a particular market. And political shocks, which is a little bit different from regulatory. It's political scrutiny, or lean in from one side, lean in, lean out from the other side. So simulation is different. It's about running your leadership through a real time. If A happens, what about B? And then there's the kind of wargaming that we hear about. I mean, I know Emily is here, so CNES has run some terrific exercises where they would present to a suite of companies, red team, blue team, China, Taiwan exercise. That's different. So I would say that if I were to hone in on one, it's that middle piece of a simulation and thinking through not just the kinetic stuff, which everyone tends to focus on, but year on year, whereas last year many of our clients were focused on those kinetic moments, this year, frankly, a lot more are focused on questions around regulatory shocks and around political and obviously market. So just worth thinking about what these words are and what you want to get out of them as a company.
No, thank you. Now, Sally, let's go the investor lens. Let's think about this in the context of the work you do around identifying opportunities. You're an economist with a wonderful reputation in the markets. How do you factor in geopolitical issues? How do they manifest in your mind in what you're doing and what you see?
Sure, thanks, Arthur. So I think step one for us is just being really clear, I think, with many of our clients, because this is an educational process for a lot of them. We call it regime change. And so what we're saying to them is that that world that you've been investing in for the last 20 or 30 years, which was a pretty benign world and frankly a pretty fertile one for most portfolios, is characterised by a commitment to free trade, free movement of capital and labour around the world, a secular decline in interest rates, which provided a huge valuation tailwind to most real assets. That world is over. So it was nice while it lasted, and you could be pretty lazy and run a 60-40 portfolio and pretty much live happily after and not worry too much. And now we're moving into a world where it's not about free movement of capital and labour. And so the sorts of discussions we're having with our clients is you need to run diversified portfolios. However, there are some aspects of that diversification that might not work as well anymore. So for example, geographic diversification is now quite difficult. And so we are having conversations with clients which are really quite unique about saying there are certain parts of the world where if we really care about the preservation of your capital, we might ask the question, you can invest in that market, but are you 100% sure that you can withdraw your capital exactly when you want? That's probably not a conversation we would have had 10 or 20 years ago. So those sorts of things I think are really interesting, but at the same time, as you said, there are opportunities as well. And so if we think about some of the broader themes that are impacting economies as we transition into this new regime, we're talking about higher competition for capital. So all else equal, that's going to push up the whole term structure of interest rates in most economies. We're talking about a world where all of those tailwinds to lower disinflation have probably worked their way through the global economy, and we're now starting to worry about tailwinds to higher inflation. So thinking about how do we build resiliency into portfolios for higher levels of inflation than we've been used to. So that might be having a higher allocation to commodities, having a higher allocation to those particular real assets that have built-in hedges against inflation. And then also, we talk about the impact that geopolitics has on potential asset pricing. So in a more volatile world, you need, all else equal, to price in more risk premia to all your asset classes. And there are some, and we're already seeing this in the markets, that are doing particularly well. So gold is a really, I think, interesting example where we can talk about sort of short-term influences on gold, like perhaps people worrying about the risk of higher inflation. But one of the fundamental reasons we've been quite bullish on gold is basically because of what happened in 2022 when Russia invaded Ukraine. Effectively, European and US authorities froze access to Russia's foreign exchange reserves in those currencies. And so other central banks, I think, have observed that dynamic and said, well, maybe it's not such a great idea that we hold so many of our foreign exchange reserves in euro and dollars, because we now know that perhaps if we don't act as others would like, we might have those reserves frozen. And so there is a structural bid in the gold market by central banks who are long-term investors taking some of their reserves away from euro and dollars and putting them into gold because they feel that that can't ever be frozen or taken away from them. So, the geopolitics, matters at a portfolio construction level. It also matters for relative asset prices. And so from an investor's perspective, this is a really different environment for constructing and building portfolios to the one that has prevailed for the last 20 or 30 years.
So on one level, you're saying the deflation headwinds that we saw over time, the great disinflation, which China was an important part as it flooded the world with goods and whatever, that sort of era passing. We're in an era where the headwinds are the other way, as it were, towards higher inflation, supply chains among trusted allies and partners, and valuations. You talked about the headwinds there. So you're talking about a world where structurally inflation is expected to be higher. And what's the response to that? Is it the classic monetary policy response, or do we have to change the way we think about this and deal with it? So
that's a great question. So, just like it's been a good time to be an investor in the last 20 or 30 years, it's actually been quite nice to run a central bank as well, because, you basically had a lot of confidence in the supply side of the economy, and effectively central banking was about that demand management, and you had a nice inflation targeting framework. And if anything, the problem was, how do we get inflation a little bit higher, not how do we get it lower? Going forward, I think that's a far more challenging proposition for central banks, because all the sorts of things we've talked about this morning, whether it be around supply chains, whether it be around industry policy, these are all things that impact the supply side of economies. And so if you're a central banker and you know that the demand side moves around, that's just what happens over a cycle, but if the supply side is moving as well and you have less confidence about where that will settle, that's actually a really difficult situation to navigate. And so I think from our perspective, when we think about, well, what does that mean for investors? I think that means we're probably going to have shorter economic cycles, so more volatility or more amplitude in the cycle, more ups and downs in interest rates, more volatility in financial markets. I think it's going to be one of those environments where you really want to have a very sound, defensible, robust framework for thinking about asset allocation, because if you can get that part right, I think most of it will take care of itself. But it's going to be a very challenging, but also some great opportunities as well for investors if you're in the right part of the market. But I think that the key point is really different environment for investing relative to the one that we've been used to.
Thank you. And Nev, you're out there, you're in business, you help companies determine these sorts of decisions, how to allocate capital, where to invest and all the rest of it. How is this geopolitical environment impacting you as you think about stuff in business?
Yeah, thanks, Arthur. And thank you also to the organisers and John Kunkel for the conference. I think it's been a fantastic success to date, and looking forward to the rest of the conference. Look, the geopolitical environment is top of mind, I would say, in most businesses today, where you've got any exposure whatsoever to a global supply chain or a global market and customer network. And for most of Australian businesses, that's the case, either one way or another. I think the big impacts that we've seen is the cost and unreliability in supply chains, which has pushed the working capital investment up in a lot of businesses significantly. I think it's one of the hidden corrosive elements of the supply chain disruptions that we've seen. And coupled with that, an increase in the cost of capital has meant that the investment in these businesses has increased dramatically, and in some cases has eroded margins to a point where those businesses are contracting out. And I think the housing construction market in Australia is a classic example of this. It's not only that the cost of goods has increased on top of the cost of labour, it's also the availability and the time frames. So today, a house that took 9 months to build is taking around 18 months to build, and the additional working capital that's invested in that and the cost of that working capital is very erosive to margins, and therefore we've seen builders go out of business or alternatively of just building out their current block of houses and intending to exit. On the other side of the coin are those export exposed businesses, and certainly in Western Australia, 2/3 of our exports go to China. So we have a very, very high level of market concentration, and I think the tried answer from everyone is, well, you should diversify your customer base. But the reality is that's not possible. And the reason we sell so much iron ore and energy and lithium to China, as well as nickel and copper and a whole bunch of other commodities, is because the demand is drawn through China. So I say to those people that say, why do you sell all your iron ore to China? I say, because you're buying all the goods that they make from iron ore at the other side. So there's a balance here between the demand and the supply. I think of recent times we've learnt we have to be very resilient to the geopolitical environment, but the one that looms in our heads and our minds around the board table constantly is the relationship with China. I think business understands, as we've heard here today, that John put it, thread the needle between getting the balance right between the economic relationships and the national security and national interest. I see that we need to live in those two worlds for a very long time to come. I don't see any rapid change in our dependence on that. There is some attempts to establish manufacturing businesses in other, shall we call it, low-cost countries, and there's some attempts to domesticate supply chains back into Australia. But I think they're very much at the margin. And having recently just tried to get some investment up to build a fertiliser plant in Australia, I can tell you that the difficulties through approvals and permitting, the access to capital and the cost of that capital, the cost of construction and the likely delays to that mean that we've got some very high hurdles to domesticating supply chains. And for the most part, we're happy to continue importing a lot of goods that have got very high carbon footprints elsewhere, rather than address and face up to the issues of how do we continue to develop an Australian economy that is conducive to building manufacturing businesses and downstream processing.
So one of the areas of great opportunity that have been identified in this brave new world is around electric vehicles, batteries, magnets, which require rare earths, critical minerals as they're called. And, you know, as Paul Keating would say, every galah in the pet shop is now talking about, you know, critical minerals and value adding in Australia. What, based on what you just said about the difficulty of replicating supply chains, is it realistic for Australia to look at value adding in the critical mineral space, or are we just going to extract the stuff and export it to someone else?
Arthur, I think there's an opportunity for us here, and with all of the challenges and risks comes opportunity. But we're going to have to be a little more clear-eyed about it, I think, than what we have been to date, because all of these businesses are not going to be able to develop downstream processing, particularly in things like rare earths. Rare earths is 14 elements, incredibly complex, very, very polluting chemical processes that are required to do it, highly energy intensive. And the reality is that even if we're able to produce a few of those elements, the rest of the bulk concentrate will be shipped off overseas to be processed in China or India or Vietnam or Malaysia or somewhere like that, because we don't have those elements that I spoke about before: the cost of capital, the environmental and permitting approvals process, the access to labour, etc., etc. So I think the reality is, while we might be able to make some elements of it, it's going to be rare for us to get businesses up that do it. The second thing I'd say is we may be able to extend our reach down the supply chain significantly from where we are today. But the question is, how far down the supply chain? Because I think if you take rare earths again, by the time you get into a rare earth magnet, which is in a motor or a wind turbine or a device like that, there are a lot of steps beyond which beyond the pure processing into rare earth elements. So even if we process to rare earth elements right now, the market for those would be predominantly the same countries that are doing the processing. And of course, if you control the whole supply chain, which is the case for a large number of elements with China, then you can decide who along that supply chain is going to make margin and who isn't. So you can play a tune there for probably several decades before we emerge out the other side. I personally think that Australia needs to be looking at support for industry much more than trying to pick winners in this space. It's going to be very difficult. It's very difficult for investment houses like JP Weir to select with the investment team, the knowledge, the experience, and the focus that they have, and yet we think that we can select a couple of winning companies out of something as complex as rare earths or lithium. I think there's a high probability that we'll get those wrong. So we should be looking at broader industry support to build that base from the ground up.
And so if you were king for a day, or you had Albanese and others, Prime Minister and others, I should say, in the room, what are 2 to 3 things you would say are the top level things to improve Australia's competitiveness and productivity?
I think number one, very, very loud and clear, is approvals and permitting. And it's not that we're pushing back against the need for checks and balances. I think all businesses, we're all citizens of the same country here. We all want the same outcomes environmentally and from a heritage and a societal point of view. But it is the process that we go through, the length of time, the lack of transparency and certainty, and the inefficiency of that process that is what's costing business. So today you have to have a very resilient balance sheet to see through any sort of approval process, even for the simplest of downstream processing. So I think that's number one. We need greater levels of certainty and particularly greater understanding of what the objectives of that approval process are. Reducing the duplication, and particularly between federal and state environmental laws. I think that one is well spoken about. What did John call it? A much admired problem. I think it certainly fits into that category. So that is number one. The second one I would say is to take more of an industry approach around labour supply and the cost of labour and training, because increasingly in Australia I think we're turning to automation and artificial intelligence to replace labour, because we're not able to solve for the skills and availability that we need there. So I would say those are the 2 top priorities.
Thanks. I'm going to come to you, Sally. There are all sorts of economic events that can have geopolitical implications. Looking at the US, debt and deficits have been building. They've been building for a while. The US has the luxury of a reserve currency. When you look at that issue, that sort of macro issue, what sort of lens do you put on it? Do you see it as a near-term issue, a longer-term issue? It doesn't really factor in. How do you think about it?
So we spend a fair bit of time thinking and talking about that. And in fact, I would say that's one thing that our clients are talking and asking us about more frequently now. It seems to be on investors' radar a bit more today than perhaps it was a couple of years ago. And so for us, when we look at the US deficit, on pretty much any measure of sustainability, it doesn't really pass. So the US have an unsustainable fiscal situation. And I think from a geopolitical perspective, one of the issues for them is that they have strategic competitors who are funding that deficit. So we've talked a bit about today about, China and others liking to have leverage or levers that they can use to sort of influence outcomes. That's a big one, effectively for the US. And so we do worry about that. And for us, we tend to be longer term investors at JB Weir. And we think in terms of sort of the length of an average economic cycle, which historically has tended to be 6 to 7 years, we now feel that issue of the US fiscal situation is on our, investment horizon. So the big question really for us is, how does that issue get resolved? So do you have, I guess, an experience like we've seen in French financial markets in the last couple of weeks, the UK, when Liz Truss was Prime Minister for a month or so, where markets force the resolution and effectively say, we're not happy with the way or the trajectory for the deficit. And so, we're going to respond to that by either charging you more to borrow, so higher rates, or potentially as well a lower US dollar. That's one way that it could resolve. That's probably not going to be an overly great outcome for the US economy in the short run. Or you could see another path where the US sort of takes the easy way out and says, well, you know what, we'll just get the Fed to buy the debt, we'll monetize the debt. That's going to be pretty devastating, I think, for the US dollar. I mean, that's full-blown currency debasement, so not a great outcome either. So this is we think, a meaningful issue. Probably don't have to worry about it in the next 12 months, but in terms of our investment horizon, we do worry about that a lot. Yeah.
One footnote to that, the Trump tax cuts expire at the end of 2025. President Trump, if he's re-elected, says he wants to renew the tax cuts. President Biden is saying he wouldn't, except you'll have to do something for people below $400,000 because they will have increased tax rates. So those sorts of fiscal shocks, do you think they are potentially something which can also impact markets then, depending on how that is handled?
Yeah, I mean, we know the US dollar is the reserve currency. The US Treasury market is probably the most liquid, most traded bond market in the world. So, if you have a resolution to the US fiscal situation that turns quite messy, that will be hugely significant, we think, for US financial markets in particular, and probably for the rest of the world. For a country like Australia, we stand out really well in that context. So we have what I would call a flow problem, not a stock problem. So, our government debt is about 40% of GDP. The US is at 100. However, we do run a structural budget deficit. And so it means that if we were to look back 10 years, that number was 20% of GDP. So countries like Australia, I think, who have a relatively sound fiscal backdrop will probably do pretty well in an environment where the world starts to fret about the US fiscal situation. But I think if the market forces a resolution, that will be pretty messy.
Thank you. Now, Ziad, you're going to bring this home, right? And I'm going to ask you about a global risk index. And let's say in November there's a change of administration in the US, and you had an index 1 to 10. What impact a change of administration in the US do you think would have on that risk index, with 10 being extremely high, 1 being very low?
Before I come to that, and I will answer that, Arthur, have no fear. I just wanted to make 2 quick points. I think one is on the silver linings, and then the other is another feature of what's on the mind of CEOs. On the silver linings, I think that the 3 areas that come up in my conversations with CEOs tend to be, number 1, new markets of opportunity. So we haven't quite squarely talked about it, but the Indias, the ASEAN markets, the Mexicos. The second is sort of these key sectors and the industrial policies around them, whether it's energy or defense or chips, and there are opportunities there. And then, there is the third thing, which, Arthur, you know well, which is these new agile configurations or mini-lateral arrangements that are sprouting up, a Quad, an AUKUS, and the ecosystems around those, where particularly, again, in the defense sector, companies see opportunities. Now, running through all of those is still risk. If you think of these additional markets, right, that could be viewed as silver linings, there is inherent political risk. There is a risk of going from a boiling pot to a simmering pot. If they're a democratic state, there's a risk of paralysis. If there is a one-party state, there's a risk of one anti-corruption campaign freezing the whole system. Similarly with industrial policy, the risk is, will it translate into action? And then with these sort of mini-lateral arrangements, do those last if there are changes in government? So again, to use your word, being clear-eyed about even the opportunity is important. Secondly, on this point of geopolitical resilience, one thing that we didn't talk about that amazes me how often it comes up is it isn't just about supply chains and data and all these clinical things. One of the top things on the minds of boards and CEOs is, frankly speaking, their people. How do I even communicate and talk to my people about this issue? They're not all of the same cloth. Where you sit, as I said, where you stand, or geopolitics in some level is personal. So how do you communicate in your own organization, your assessment of your geopolitical responsibility. How do you communicate that outside? What do you say to your shareholders? Are these voices the same? Do they conflict? So there is a real question about engagement internally and externally that's on the minds of boards as well. To your question, 1 to 10, I won't give a number to it per se, but I think, again, in the spirit of being forensic, one has to think of it as what are going to be the areas of continuity in a Trump 2, and what are going to be areas of discontinuity. And broad strokes, I think on the China question, yes, there may be an approach that's different with allies, but there is a general bipartisan consensus. On the Middle East, similarly, I think we would see continued efforts around the Abraham Accords and that effort. But I think the area of discontinuity that would likely emerge is around Russia, Europe, and the approach towards Ukraine. So I think, it is easy to kind of reduce this to a number, but that wouldn't really do this audience much service. It's worth breaking it down by policy, area, dimension, and that's the granularity that this geopolitical moment demands.
But when you're out talking to clients, almost everybody's asking about the outcome of the election.
Yeah.
And we have the same thing, and then we try and break it down into policy areas.
Right.
And one area where we think there's a fair degree of continuity, because there was from Trump to Biden, is around China. So how do you see China policy evolving, whether it's Trump or Biden in the White House?
Yeah. Look, I think there is a question about differences in approach. We were just talking about this with our colleague from Korea, right? A lot of it is also going to just come down to personnel. Who is inhabiting Treasury, USTR, state, these key roles? So there's a level of the style and approach that a President Trump might bring. There's a question of also, obviously, the appointments that will matter as well. And then, honestly, again, I think we reduce this whole conversation to the US. It is a principal actor, but there's also the question of what position will some of its allies take? What position will a newly elected president in Taiwan take? What is going to be the continuity of some of the key governments in Manila, Tokyo, Korea? How are they going to evolve in their position? So I wouldn't want to, again, reduce it to this will happen and this will be the flow of US-China. But again, I think it's a close election. We're going to have to see what happens. So that isn't the prediction. What one could watch is who are the appointments, what are the arguments they're making right now, and we're starting to see some of those. And then there's the good old-fashioned element of unpredictability of the whole thing. That makes it so interesting.
I'm going to throw to Sally and Neville. Each of you, apart from things like the US election, what is one thing you're particularly anticipating or thinking about over the next 12 months? Sally.
So one thing that we're talking to our clients about, which is not really the consensus view, is just to be a little bit open-minded about where interest rates might head domestically. So there's I guess an enthusiasm and a willingness to embrace this idea that the next move in rates is down in Australia. That'll happen before the end of the year. I wouldn't be so sure about that, and so we are saying to our clients, let's just be a little bit more open-minded when we think about allocations into fixed income, or what we may or may not be doing with term deposits, or what stocks we might be buying locally, just to be cognizant of the risk that rates might actually go up before they come down.
Nev?
Very, very similar. In fact, I think the price and access to capital is very much looming large in most corporates' minds today, because it has changed the whole investment environment for us as to how we look at capital returns for businesses. So I think that's certainly number one. And the second one, as I said before, is the issue around labour.
Excellent.
Arthur, can I add one
Yes.
thing? The third plenum is quite important to watch as well.
Yeah.
What is happening inside of China? Richard and I were just briefly speaking about that. That is going to give us a sense of what is the economic direction, whether you view it as a synthesis of moves being made or a big bang statement. That is a debate. But I do think we need to continue to watch the events and the moves being made within China itself too.
No, great point. We're going to finish on that point. It's been a masterclass. We could have gone for a lot longer. There are all sorts of stuff we could tease out. But I hope what you've got out of it is that while there's complexity, there are ways to analyse complexity, and there are ways to think about the risks as well as the opportunities. And you've had a great panel to do that, so please thank them.